2020 is the year of the SPAC, the Special Purpose Acquisition Companies. Basically, they're just blank check companies that fast track private companies to go IPO. So today we're going to talk about SPACs and exactly what they are. Let's roll that intro. What's up guys, my name is Humphrey and welcome back to my channel. As of this year alone, a record 82 special purpose acquisition corporations went public this year to raise a record $31 billion and more are on the way. But what the hell is a SPAC? So let's get into today's format, and first we'll talk about what a SPAC is. Second, we'll talk about how they work. Third, we'll talk about the most notable companies to go public using a SPAC to date and how they've performed. And lastly, we'll talk about 3 SPAC companies you should be keeping an eye on, which are LCA, SPAQ, and ticker symbol FMCI. So let's get into part 1. What is a SPAC? Simply put, a SPAC is already a public company and its main purpose is to raise money to take a private company public. I know that's a bit confusing, so let's talk about how that exactly works out. Essentially, all you really need to know is that a bunch of investors get together, they form a company, a public company at this point, and that company has no operations at all, so that company essentially does nothing. It doesn't produce anything, it doesn't make any money, but its main purpose is to acquire a private company and take it public. That actually happens because the SPAC is public already, so when the private company gets acquired by that SPAC, which is already public, through a reverse merger, that private company becomes public, and then they basically create a new ticker symbol for that company, and then they just start trading those shares. So why would a private company want to pursue an acquisition via a SPAC instead of just going public the normal way? Well, the normal way of going public could actually take a long time. It usually takes a year or slightly more than a year to even go public, and you have to deal with what's called the Securities and Exchange Commission. Because of the involvement with the SEC, the process takes a lot longer and is heavily more scrutinized by the SEC itself. The SPAC route, on the other hand, can be done within a few months with little SEC involvement. Not only this, if the private company goes public in the traditional route of going through an IPO, they can set their share price before the IPO, but once the IPO actually happens and the shares are traded on the public market, they're not really protected against the market forces, so they're kind of just subject to what the market dictates the price to be at. Versus in a SPAC, the price is pre-negotiated, so the company knows exactly how much capital that they're going to raise through the SPAC, so it basically protects them against the market forces a little bit. So why are SPACs so hot right now? I've heard that 2020 is the year of the SPAC, but really before 2020, I hadn't really heard too much buzz about a SPAC. So what really makes them hot right now? In the years following the financial crisis, capital was a lot harder to come by. There was a lot of regulatory scrutiny when it came to companies going IPO, and there were a lot fewer private companies that wanted to go IPO at the time. SPACs typically have 2 years to complete an acquisition after they set out to do so, and so basically after the financial crisis, that might have been uncertain, versus these days, it might be a lot easier to get a deal done within 2 years. SPACs have always been around, but as years go by, they are gaining popularity. Their IPO fundraising hit a record $13.6 billion in 2019, more than 4 times the $3.2 billion that they raised in 2016. Let's talk about some notable companies that have gone public via a SPAC in the last year. The top 3 that come to mind are DraftKings, Nikola Motors, and Virgin Galactic. In terms of returns, DraftKings is up 258% year to date, Nikola is up over 200% year to date, and Virgin Galactic is up 35% in 2020. These 3 companies alone gave a lot of credibility to being acquired via a SPAC and going public via a SPAC that I think has really changed the entire landscape of going public for this year. According to MarketWatch, the common shares of the 21 SPAC mergers completed in the period from January 1st to July are averaging a 13.1% return from their offer price. But that's mostly due to the 2 highest performers, DraftKings and Nikola. If you took those 2 out, they actually didn't perform that well. What's really notable here is that there are a ton of SPAC acquisitions going on in the background, but really we are only drawn to the ones that make the most headlines, which are DraftKings and Nikola this year. So which SPACs should we be actually paying attention to as investors this year? Since there are SPACs out there that are trading pre-merger, this next section is a little bit speculative. I'm going to go over 3 SPACs that you should be paying attention to and doing your own research on. I just want to throw a quick disclaimer out there that I did all the research for you guys, but I'm just summarizing the information and presenting it to you. It's really up to you if you want to buy it or not. I'm not a financial advisor in any way, and I'm not condoning that you should be buying these shares of SPACs. I'm just letting you know that the information is here and you can do whatever you want with it. Okay, now that that's out of the way, the first SPAC that we should be paying attention to is ticker symbol LCA. LCA stands for Lancadia Holdings, and basically they are a special purpose acquisition company looking to acquire Golden Nugget Online Gaming. This deal is expected to close at the end of Q3 2020, so that's coming up pretty soon, and currently its share price is about $17.5. And then the LCA ticker symbol will actually become Golden Nugget Online, which will be ticker symbol GNOG. Golden Nugget Online basically offers a wide variety of sports betting and casino games all online. And the reason why this one is so much in the news is because of the comparable company that went public via SPAC this year, which was DraftKings. DraftKings has an $11 billion valuation versus Golden Nugget Online only has a $745 million valuation. People are speculating that if the deal goes through, that Golden Nugget Online fits a really good niche right now, especially in a post-COVID world where nobody can really go to real casinos, that they're going to do a lot of their online gambling online. Also, that this acquisition will draw comparables to DraftKings and slowly bring their valuation up closer to a DraftKings level. The other thing that it has going for it is that Golden Nugget Online is ran by a billionaire named Tilman Fertitta, and he's a regular correspondent on CNBC. Having a well-known CEO increases the confidence of investors and also the exposure that it's going to actually bring to LCA and Golden Nugget Gaming is one that many investors are bullish on. Speaking of well-known CEOs, let's talk about the next SPAC that you should be paying attention to, and that's ticker symbol SPAQ. And this SPAC is basically a merger deal for Fisker Inc. If you don't know who Henrik Fisker is, he was the man that was competing with Elon Musk in the early electric vehicle days to take market share for the electrical vehicle market. He happens to also be the designer of the BMW Z8, the Aston Martin DB9, and the Aston Martin Vantage, to name a few. His first electric vehicle was the Fisker Karma, and that actually debuted in 2011 and 2012. They made about 2,500 Fisker Karma cars before the company ultimately went bankrupt in 2013. The main reason why they went bankrupt is because their sole battery manufacturer at the time went out of business. So when your battery manufacturer goes out of business and you have an electric vehicle, well, guess what? You go out of business as well. So not many people remember this, but before the Model S became the most mainstream electric vehicle on the market, the other one competing with it was the Fisker Karma at the time. At the time, back in 2012, I remember going to the Stanford Shopping Center, which is really close to me, and I remember seeing the Fisker Karma just parked in the hallways of the mall, and that was kind of like a marketing tactic at the time to generate some interest and generate some buzz. But I remember thinking to myself, man, that's a really cool car. I hope that it comes out, and I hope that it actually starts to dominate the electrical vehicle space. Another funny story is that when I was an investment banking intern, one of the directors at my firm that I was working at actually had a Fisker Karma, and his was one of the 3 Fisker Karmas that actually caught on fire. So Fisker Karma had some incidents with fire and actually had a lot of battery recalls, and obviously it didn't end well for them. But Fisker Inc. is Henrik Fisker's relaunch of his previous automotive brand, and you better believe that he is pissed about the first one, and he's going to try to make this one the best that it could possibly be. So this time around, Fisker wants to make what's called the Fisker Ocean. It's going to be an outsourced manufacturing job, so Volkswagen has actually been in talks to be the manufacturer of the Fisker Ocean, and he's going to also sell it completely online, just like a Tesla would be. As of August 2020, they have 7,000 reservations for the Fisker Ocean, amounting to about $350 million in revenue. Here's the chart of the market cap comparison of pure electric vehicle peers currently, and we can see that Fisker's valuation seems somewhat reasonable compared to these other EV makers, but the only real EV maker here I would consider is Tesla. And their valuation is pretty crazy. Also, this table is a little bit old, so take that with a grain of salt. So if we were to invest in SPAQ, the play is actually pretty speculative, but people are bullish because of Henrik Fisker. He's actually done it before. He's put out an electric vehicle on the market. And to be honest, if I was investing in any new company that was trying to make electric vehicles, I would rather bet on the guy who's done it before than someone who's never done it at all. If you are going to invest some money into SPAQ, make sure it's only money that you can afford to lose. There are a few risks involved. Besides usual SPAC acquisition risks, like for example, if the deal goes through, there are some specific risks in this scenario that I want to highlight. First is that the VW deal isn't actually solidified yet, so if that falls through, then this investment actually kind of sucks. Second, there's a lot of competition out there. Obviously, Tesla is going to be Tesla and they're going to continue pumping out cars, but also traditional automakers are getting into the electric vehicle game, so that could be a potential threat for Fisker. And third, even if they do have a manufacturing deal, they've never actually manufactured the Fisker Ocean before, so obviously there's going to be some delays. There's always delays with manufacturing, so that could be a potential risk. So yeah, take a look at SPAQ if you're interested, and let me know in the comments below if you're going to be buying it or just staying on the sidelines until something more substantial actually formulates. The last SPAC I want to cover is ticker symbol FMCI. FMCI is known as Foreign Merger 2, and it's a SPAC that recently announced a deal to acquire Itella International, looking to close in Q3 of 2020 and take Tattooed Chef, a plant food-based company, public. Tattooed Chef offers a wider variety of plant-based foods than Beyond Meat, which is their closest comparable company, and is already in 7% of Walmart stores. The CEO is confident that they'll be in half of the Walmart stores by the end of the year, but even if they're only in 25% of Walmart stores, I would still consider that a pretty big win. Also, Costco is another client that they're in as well. Their goal is basically to compete with Beyond Meat. So currently it's trading for about $24 per share, and the reason to own this SPAC would be twofold. First, the plant-based food market has grown to about $5 billion in the past 2 years, and relative to Beyond Meat, this company is actually quite cheap. The stock is set to debut in the public markets with an enterprise value of $482 million. It trades for a multiple of 15.6 times forward enterprise value over EBITDA and 2.2 times forward enterprise value over sales. To compare, rival Beyond Meat trades for nearly 200 times forward enterprise value EBITDA and 17 times forward enterprise value sales. From 2019 to 2020, EBITDA margins jumped 8.2 to 11.6% for this company. This year, that margin is set to actually expand to 13.9% EBITDA, which is far higher than Beyond Meat's EBITDA margin. So this SPAC is pretty interesting and spicy. It's also pretty speculative, so let me know what you guys think of this SPAC in the comments as well below. Anyways, guys, I hope that this was a great overview of what a SPAC is, how they actually operate, and we've actually talked about some notable SPACs to go on public this year and also some SPACs to keep an eye on. If you got any value out of this video, please drop it a like, subscribe to my channel for more videos, and hit that notification bell so you can get notified every time I post a new video. Feel free to follow me on Instagram. I post there pretty much daily, so if you're ever just bored, like scrolling the gram and you want to see more of me, that's where you can find me. If you'd like one free stock valued up to $1,600 when you deposit $100, you can use the link to Webull in my description below. Lastly, I do all my research using a premium service of Seeking Alpha, so if you feel like supporting my research, please check out my Patreon below. It's in the description. And a huge thank you to all the supporters right now. I'm going to put all you guys up on the screen. And all right, guys, that was the video, so I really appreciate it. Hope you guys have a good one. See you next time.